Awesome. Looks like we're about halfway filled with attendance. I'll give us another 60 seconds here. We'll go ahead. All right, everyone. Well, happiest almost Friday. Again, want to thank everyone for joining. We have an awesome webinar planned for you guys today with our panelist. We're going to be exploring alternative investments for self-directed IRAs. We will have a live Q&A session. This session is being recorded. We'll be happy to follow up after the webinar. You can feel free to ask questions as we go along via the chat, but just know that we will have a live Q&A at the end of the session where we allow for you to unmute or throw your questions in chat. So without further ado, we're going to go ahead and get started with Andy. Andy, you're on mute.
Thanks, Dia.
Of course.
Okay. And my part of the presentation is called Alternate Investments as a Wealth Enhancement and Preservation Tool. Basically, what I'm going to discuss is what is an alternate investment and how it is put into an investment portfolio and what's some of the benefits of adding alternate investments into client portfolios. So with that, next section. Um, one of the things I wanted to start off with is our general disclosure regarding my presentation. The information today do not guarantee any future performance or results. The statements expressed are intended for informational and educational purposes only and do not constitute investment advice or any solicitation to purchase or sell any specific securities. Investing in alternate investments entail risks, as I will outline shortly, and actual client portfolios are dependent on their individual financial situation and risk tolerance. So with that, I'll kick into the meat and potatoes of the presentation. So what is an alternate investment? Alternate investments are non-traditional investments outside of public equities, which are stocks, fixed income, which are bonds, and cash instruments like CDs and money markets. Um, some of the specific strategies that are considered alternative investments are private equity, private credit, venture capital, hedge funds, direct real estate, commodities, digital assets, and more. And some of the key characteristics of alternative investments are limited access to regular investors. Um, a perfect example is you must be an accredited investor or qualified purchaser status in most cases. And what that means is you have to have a certain level of net worth or income to be qualified to purchase some of these private investments. Another key characteristic is not all wealth management firms offer um, all the different alternate investments that are out there, and it does require some specialized access. In terms of the characteristics of alternate investments, the risk profile of alternate investments are very different from public markets. The biggest one is being the lack of liquidity. Some of the alternative strategies that we discussed today do have lockup periods that entail at least 5 or 10 plus years of lockup. So that's one of the key differentiators of alternative investments versus public markets. Another one is valuation risk. It's hard to price some of these investment strategies, so that because of the limited market, they do have pricing issues with some of these investments. And finally, a lot of the investment strategies, because the nature of the investments, the complexity of them, they do entail higher fees to some of these strategies. But with that said, despite these risks, there are significant advantages of having alternative investments in your portfolios. Diversification is number one, which I'll get into more deeply later on, and potential for higher returns are probably the two biggest advantages of having alternative investments in your investment portfolios. Okay, next slide. In terms of our investment philosophy, portfolio construction, number one, asset allocation is fundamental to what we do, and actually the industry as a whole. Diversification works and helps manage risk and capture most of the global market returns. That's really no different from a lot of our competitors, but asset allocation is pretty fundamental. I think the area that is kind of a key differentiator for us is that we do believe private markets do provide additional level um, for our clients. I think this is important because in today's market, um, where everyone's capturing kind of the same similar type of returns, in order to differentiate yourself, you want to provide an extra layer of downside risk and then find ways to get excess returns and then able to meet your goals. And finally, we do believe that the investment portfolios do need to be aligned with our individual's client goals. Okay, next slide. This is probably my most technical slide that I'll present today. This is with regards to alternative correlations and returns. Um, this particular graph shows two things, annualized returns on the y-axis, and on the x-axis is the correlation levels. I'm going to focus a little bit more on the correlation side of things. If you look at the far right, you can see a standard traditional portfolio of 60% equities, 40% fixed income. To the far right, that has a correlation of one. And just to give you an explanation of what correlation is, a correlation a one basically means two variables are moving in perfect unison together. A correlation of zero means there's actually no relationship between the two variables. And negative correlation basically means um, um, negative correlation means that the two variables move in opposite direction of each other. So if you look at the different alternative investment strategies. I'm not going to go through all of them. You can see kind of where things fall on this particular spectrum of returns and correlation levels. If you look at the far right, the real estate asset class, has a negative correlation to a traditional 60/40 portfolio. Um, Real estate has a little bit of a muted return compared to a 60/40 portfolio over the last 10 years, at probably closer to around an average of 5% returns. If you look at absolute return hedge funds, which is kind of a broad bucket of hedge funds that are out there, kind of similar story. Correlations are getting closer to a 60/40 portfolio, but it is below, um, a correlation of one, and it has about a zero point 0.3 type of correlation and similar return profile, about 5% to real estate. And once you get into private credit, the return profile is very similar to a 60/40 portfolio, um, with about a 10% annualized return over the last 10 years. I think the big differentiators is if you look above the 10% mark, you can see that venture capital and private equity is actually closer to a 15% annualized return over a typical 60/40 portfolio. And these two particular asset classes do provide excess returns over the last 10 years. Okay. And in terms of the next slide, um, portfolio construction, this is how we view building client portfolios. We utilize what we call a core satellite approach. And the core portion is basically just a standard equity and fixed income portfolio. I think the only differentiator from our standpoint is that we try to get access to the public markets as efficiently as possible and invest in primarily low cost index funds like a Vanguard or an iShares. We really prefer to pass on those savings to our clients in terms of investment expenses. But we do overlay some active managers to our client portfolios. There's certain asset classes that do perform better um, with active management than others. A perfect example is fixed income. The fixed income markets are significantly bigger than the equity market. So active managers, you can find some pretty good managers in that space. I think the one area that we do differentiate ourselves is that we do put private equity and private credit into um, most of our client portfolios. I wouldn't say all. It really depends on the client situation, but we do invest in private equity and private credit as differentiators and for diversification purposes and return purposes as well. And finally, probably the number one question as a wealth manager I get is, what's our general outlook on various parts of the market? I'm not going to go through each asset class, but I do want to focus on how we generally look at the alternative investment space. And number one, private equity. Private equity has shown that it's provided excess returns for quite a bit of time. The reason being is that private equity does provide what we call an illiquidity premium. It does provide excess return. If you can lock up your funds for, 10 plus years, they do provide extra returns that public markets do not provide. And I would say the next is private credit. Private credit's been in the headlines, in the news over the last 6 months. Despite its struggles and kind of the negative headlines, most of the private credit managers that we've spoken to say this is actually a really good time to invest in private credit just because there are a lot of distressed private credit investment vehicles that are out there. So there's a lot of opportunity there. And finally, what we pretty much emphasize to all our clients, alternative assets continue to add diversification and excess returns, to their portfolios. Our job as portfolio managers, we do want to manage risk, but we want to actually get returns as well. Um, and with that, that concludes my portion of the presentation. If you do have any specific questions that I don't answer today, feel free to contact me, with the information that I provide here. And even if you would like to have an understanding of how your current portfolio is aligned, feel free to reach out. But next up is Mike Treidl. He's going to provide a little bit more detail with regards to one of the strategies out there, which is the hedge fund world and digital assets. So with that, Mike, take it away.
Great. Thanks, Andy. And thank you everyone for being here. So Andy just made the case for why alternatives belong in a portfolio: diversification, return potential, and he also mentioned that access to the best alternatives is often restricted. I'm going to zoom in on one alternative asset class in particular, digital assets. And for those of you who follow the market, I know what you're thinking. The market's well off its highs. Over the next few slides, I'll show you that it's not actually a problem, but that's the setup. And it works perfectly for what's called a Roth conversion strategy. A quick background on myself. I'm Mike Treidl, founder and CIO of Blue Coin Capital. Before this, I spent 15 plus years in institutional asset management, Morgan Stanley, Capital Group, Hayden and Regal. So I come at crypto from a traditional investment background, not as a native crypto native. I'm a CFA charter holder, and these days my full-time job is digital assets, strategy, portfolio construction, and risk management. On the next slide, I'll talk a little bit about the asset class. So let me define what we're actually talking about, because I know this room has individuals who are familiar and not so familiar with this asset class. Digital assets are scarce, decentralized assets that live on blockchain networks, transparent, programmable, accessible from anywhere in the world. Bitcoin anchors the asset class. Think of it as digital gold, a fixed supply, store of value. Ethereum's different. It's more like a global computing platform that settles value. But here's what's changed. The asset class has grown well beyond any single coin. There's a universe of large cap tokens now. And not only that, but there are crypto-related equities. Publicly traded companies like exchanges or treasury companies listed on the NASDAQ that give you exposure through completely familiar rails, common stock. The point of this slide is simple. It's not one coin or one bet. It's a maturing asset class with multiple ways to invest. Now, on the next slide, I'll show you a little bit about the legitimacy. This is actually what I want most people to hear. 5 years ago, putting crypto in a retirement account sounded fringe. Today, it's mainstream finance, and here's the evidence. Spot Bitcoin and Ethereum ETFs are approved in trading. They're run by BlackRock and Fidelity, the most established names in asset management. BlackRock, $14 trillion under management, the largest asset manager on the planet, is in on this asset class. The NASDAQ, CME, and Coinbase all publish crypto benchmark indices now. That's the same market infrastructure that exists for stocks. When the world's major exchanges build index infrastructure around an asset class, that's institutional acceptance. Fidelity offers crypto trading inside IRAs today. Pensions, endowments, corporate treasuries, they're allocating. Harvard Endowment and many other prominent institutions hold digital assets on their portfolios. So the honest takeaway, if you've been waiting on the sidelines because you felt it was too early or too risky, the institutions you trust with your money are in. You're not early anymore. You're right on time. So now let's dig in a little bit more on this Roth conversion strategy on the next slide. So here's the strategic heart of my segment. Crypto is volatile and high growth. That combination is exactly what you want inside a tax-free account. Think about it. If an asset might triple, where do you want that growth to happen? In an account where the tax is gained or where it's never taxed at all? Two things make right now especially compelling. First, it's the timing. Digital assets and Bitcoin are well off their highs, which means a conversion today happens at depressed valuations. You pay tax on a small number, and the entire recovery, whatever it may be, compounds tax-free. On the left, you can see the shape of the idea. Convert low, recover tax-free. We are here near the bottom of the curve, not the top. Second is the math. Take a simple hypothetical. I want to stress this is purely illustrative, not a projection. You convert $100,000 into a Roth, and over 10 years, it grows to $300,000. In a Roth, you withdraw that $200,000 gain and pay zero tax. In a taxable account, that same gain costs you roughly $47,000 in federal capital gains tax. And that's before California takes its share for those California residents. So it's a same investment, same growth. The wrapper alone is worth nearly 50 grand. That's the power of holding the right asset in the right account. Rob is going to go deeper on the conversion metrics, what it costs, when it makes sense, and how to do it without surprises. So let's jump forward to the next slide. This is kind of the last major piece. How do you actually own this inside a retirement account? Now, you can do it yourself inside a self-directed IRA, but in practice, it's hard. You're managing custody and private keys. You're rebalancing in a market that trades 24/7, 365. You're trying to stay current in the fastest moving asset class in finance. And most people end up making single coin bets rather than running a strategy. That's a lot to take on with your retirement money. This is where an actively managed fund earns its place. A diversified, curated basket instead of guessing which coin wins, professional custody and risk management, and someone whose full-time job it is navigating this asset class. That's what Blue Coin Fund is, a diversified, actively managed basket of crypto and crypto-related equities. And you can hold it inside your self-directed IRA through a custodian like Forge Trust. And speaking of Forge Trust, Tia is going to walk you through exactly how that account works in a moment. So on the next slide, I just want to leave you with this. The best time to plant a tree was 20 years ago. The second best time is now. The asset class is established, the wrapper's powerful, and the entry point is compelling. Curious how the account actually works? That's exactly where Tia takes us next. Tia, over to you.
Thanks so much, Mike and Andy. Both really appreciate the presentations. Give me one second here. So just to do a quick introduction, my name is Tia Henderson. I lead our relationship. I have been in this space for about 15 years, with Forge for about 4, really building this out to ensure, that we deliver with our investors. We pride ourselves on our service and our ability to support what can be a somewhat cumbersome process, to streamline and make it as efficient as possible. As with others, our legal team always wants me to do some fun disclosures. So again, we're not a bank, we're not a broker dealer. The IRS says that if you are going to hold one of these alternative investments within a tax sheltered account, it must be a self-directed platform through a qualified custodian. And so that's exactly where Forge Trust comes into play. We are a qualified custodian. We don't give investment advice. This is our bread and butter. This is all we do. We've been in this business for about 40 years. And so as both Andy and Mike alluded, alternatives are increasing in demand, great for, portfolio diversification, and becoming a lot of people's strategy in those overall retirement planning. One of the biggest benefits, as alluded, right, is that tax shelterment of the account. When you are buying, selling within this vehicle, those are not immediately taxable, okay? And there's a lot of benefits to doing the different varying account types. With traditional IRAs, those contributions can be tax deductible. Again, I'm not a tax advisor. Rob will go into the nuances of that shortly here. But again, that benefit is anything that's growing within that traditional account remains tax sheltered. And then you're only paying taxes upon distribution. So when you're actually taking custody of those funds, typically in retirement age, and those are taxed at ordinary income rates. With your Roth accounts by way of either doing a Roth conversion or after-tax contributions, this essentially is meaning that the funds in there have already been taxed. And so when you go to do a qualified withdrawal, you are taking that distribution completely tax-free. And even more so, just to edify Mike, all of those gains that have been happening completely tax-free within that account, okay? When you are buying and selling these types of investments in, say, a standard brokerage account, those are going to be subject to immediate taxation and capital gains tax. So again, that's really the benefit of using an IRA or retirement vehicle for that tax shelterment. This example here is just kind of highlighting some of that, right? So if you were to invest 100,000, you are now have returns of 200, a great return on your investment. You're not going to be taxed that $100,000 in difference. Again, you're only going to be taxed upon those distributions. Okay? Again, in a Roth, if these monies were to be gaining, you've already paid taxes. So all of that growth is completely tax-free within that. You get to take that upon retirement with no taxes upon distribution as well. So again, just a very high level kind of recap. The points to remember is with alternatives within the SDIRA space or self-directed IRA space, these are going to be tax-free growth. It's going to give you access to additional types of investments that are not available on your primary markets, right? Not through your mutual funds or traded index. These are, private equity, real estate, precious metals, Bitcoin, these varying offerings that, as Andy alluded as well, tend to have some pretty good returns overall. Again, Forge Trust role, IRS says that you have to have a qualified custodian, and this is for proper record keeping. They're saying that you're going to be holding this in a tax shelterment vehicle. We want to make sure that everything is according to IRS compliance. So we're really the record keeper, housing the valuations on our platform, reporting any money in and out so that we can report any taxable events. So a very common point that we hear and maybe a misconception around removing retirement funds is that it's a fully taxable event. And in most cases, that's just not the case. Okay. There are plenty of different ways and different qualified accounts that allow you to move funds in between qualified accounts to purchase these alternative investments, right? An indirect rollover being one of those, you're distributing funds directly to you as an account holder. The IRS says, okay, you have 60 days to then take that money and move it back into a qualified account, meaning a traditional IRA or a traditional or a Roth IRA. These can also be solo 401ks if you're self-employed. Essentially, the biggest thing is moving from one retirement account to another within that time frame. Then you have rollovers or direct rollovers, right? And that's going to be, say that you have an orphan 401k, you have an employer you used to work for, and that account's just kind of sitting there. You can request a rollover directly to your custodian of choice. So the funds would be able, in this situation, to Forge because you're not taking custody of that at all. It's coming directly to us within that 60-day. Again, not producing a tax form. On the indirect rollover, it does produce a 1099-R. However, on our side, we produce a 5498. Again, Rob will be able to talk through these in just a moment here. Those two forms kind of essentially wash because the IRS does permit that 60-day rollover rule. Then the preferred method is going to be the trustee to trustee transfer. So this would be, say you have an existing IRA with Fidelity, you're invested in stocks and bonds, you found a great alternative asset that you want to invest in, you are able to do what's called a trustee to trustee transfer, meaning that the custodian and your current contra firm work directly. The money never passes through your hands, and it's never coded as a rollover. It's not going to generate any tax forms, and the money just moves into the same taxation, allowing you to purchase that investment. And then, of course, there are always contributions. You can contribute to traditionals, SEPs, Roths, all depending on your specific tax bracket and situation, which again, Rob will get into in just a moment. So again, just to recap on Forge, the benefit of alternative investing within the SDIRA is that tax shelterment. Forge Trust really prides themselves on white glove service. I have a dedicated team that helps clients through all of the various forms, helps answer questions, and really help to deploy that capital and make the investment process as seamless as possible. Awesome. So without further ado, I'm going to go ahead and kick it over to Rob.
Pleasure to be speaking with all of you today. My name is Robert Mowry. I do a lot of pension work with life science companies here in the San Diego area as part of Delmar Life Sciences. But in working with many of them, all of them, I would say, down to a T, have a lot of the same issues that you do dealing with their taxes. How do I hold the shares in the businesses that I own? How do I navigate all these other tax considerations that me and my family are really going to set up for success in our retirement? And when I talk with people, probably the most confusing aspect that people are really have a lot of trepidation around is the simple rollover or doing a transfer to a new IRA custodian. And that's a real important piece of the puzzle that Tia so beautifully buttoned up, that it doesn't have to be scary. Going from a custodian to a custodian is a straightforward process. Form 5498 is filed. The Department of Internal Revenue Service is communicated by the custodian that your money is going from one to another, and you're 100% fine. So in this talk, we'll talk a little bit through and wrap a bow on the finer point involving that, and talk a little bit about why you might want to do a rollover for a business purpose to invest in an asset that could potentially explode if you invest like I do in something that's either going to be a huge success or not at all. And then think through, what are you trying to do in your retirement? So the most vanilla type of transfer that you can do, and I assure you of this, is a simple trustee to trustee transfer. Whether it's IRA to an IRA, 401k to an IRA, as long as it's not a Roth or something that is a different tax character, then you're completely fine. Just make sure that the custodian is able to do the proper paperwork. You'll never have to worry about the IRS knocking on your door. And then the key is that you just have to not be involved in any capacity. There are avenues where you could take money for a 60-day or less period, and that option is available to you, but you have to very clearly document it and make sure that it's part of an overall process that a lot of people think they can do it on their own, but it's so much easier to be able to have a custodian that's going to be receiving it from the get-go because the paperwork can take a little while rather than taking the money out, trying to find in diligence a good custodian that has the flexibility that Forge might, and then the time runs out. So this is probably the most interesting transfer that you might do. Mike did a great job of explaining how when you're looking at the tax treatment of a lot of your retirement investments, historically, what you want to do if you can is pay taxes now. You never know what the future could hold in terms of higher tax rates. So, to the extent that you can push off the ability to sock away as much of your assets into an account that can grow and compound tax free, that's in your best interest because really, when you're investing for retirement, time is on your side. You do well when you're betting on the decline of the dollar or all these assets that will be baked into an inflationary process. So, to the extent that you can weave in digital gold, silver, stocks that are fairly nimble and that have significant real estate component to it, and have the flexibility to get into alternative assets that have that illiquidity premium that Andy was talking about, you're going to best serve yourself for the future. And then getting into the Roth, it's just a simple process of transferring it from something that may be pre-tax with like a traditional IRA, paying that tax as an ordinary income, and then putting it into the Roth to invest into Mike's fund, any investment that really bodes well over a decade-long period to significantly grow. And so here's an example that really just doubles down on the simple math of what you're seeing in front of you is correct. Like the nature of compounding is such that if a tax bill hits you midway, it's going to cut your legs out such that you're going to have to really double in many ways, or at least in the majority of the cases that I've seen, have a significantly higher rate of return just to get back that amount that was taken out by tax. Now, tax is something that you want to be able to deal with and have as a known quantity on the front end so that when you grow and then when you hit 59 and a half and are able to take the distributions that you don't have to worry about the tax man breathing down your neck. And what's nice about a Roth IRA is you don't have an age at which you have to take those mandatory distributions. You have the flexibility to be able to let it to continue to grow. You know, when you're retired and traveling in Europe, it's continuing to march along to grow your nest egg. And so it's probably the most powerful tool to allow you to grow your wealth tax free. And while the contribution limits are relatively small, less than 10,000, the conversion aspect is unlimited. So you can push over a ton of money. And a number of my clients have done that. And certainly I've done that as well, where it's just a matter of now you can position yourself best to be able to have your assets grow and take on as much risk as you want to get to where you want to go. And the strategy here that Andy was referencing really is that you might have a traditional retirement account through an IRA that's invested in Disney stock and IBM and things that you know will incrementally go up over time. Then it'll have a dividend that can distribute to you, or you can do something within a traditional brokerage account. Where these really shine is you want something that's going to grow quite a bit. And that is really where this can work out for you in a big way, where the distributions can be reinvested, where you can sit on something. And the ways that you make the most money is being able to stomach the ups and downs and being locked into something that you would have to take a distribution penalty to take something from, minus the original principal that you can get out relatively easily, is really what gives you the diamond hands to be able to hold on while others sell, and you're well positioned for the future. There's a lot of ways you can be creative with this. So if you're like Mike and myself and really believe that some of these projects like Ethereum will be a significant component of back-end settlement of financial systems and networks, then you can hold on to a volatile asset like ETH through a fund that has significant coverage on it or that is getting a lot of the best in class assets that are tightly correlated with it, like Bluecoin is. And then all the while, let's say in an individual brokerage account, say you have some needs that need to be met, you can just sell the ETH calls, collateralized by whatever you have in there. If ETH doubles, let's say in a year time, then obviously your Roth IRA is going to do incredibly well. And then you can close out your call as the incremental time decay starts to eat away and add to your profitability. So in many ways, there's interesting ways that you can do both without incurring too much of a tax bill. The only instance that you may think about is if you're trying to tax loss harvest or do some sort of play where you're pitting one accounts against the other, but that's more of an exotic strategy. I tell people just keep it simple. If something's going to grow significantly, throw it in the Roth. And we think traditionally of a highly volatile asset. We don't think of silver. But I have a number of clients that bought silver at 17 just after COVID, thinking that the world's going to end. And they ended up not being as crazy as a lot of people thought that they were, with silver essentially 7xing, right? So it's not what Peter Thiel did in terms of buying the startup company stock and putting it in there and benefiting. Like, all different types of assets can be well suited for a Roth IRA. And in this instance, in the early years of silver in the early 2020s, like, it's not moving that much, just a few dollars a month. And now with the high implied volatility, I'm seeing people writing covered calls on their silver as well and doing quite well with that. And that allows you to continue to have that income. And then along the way, too, you can lock in your gains. So when I was at my last investment firm, some of the more successful partners said sell half when something doubles. So you've got your principal back. It can sit in your Roth IRA, doesn't mean you have to invest it right away. And so you have that flexibility to wait for the next great investment to come to you. And so, really, the only time that you're going to be paying income tax on these conversions is with a Roth, and it's because you choose to as part of your overall strategy. And that'll be reported to IRS, completely traceable. And if you get any sort of audits, you can do it all through the mail. And it's not as scary as you might imagine, I promise. And there's a lot of different varieties that you can pick from, for your, in my case, saving for my kids' college, for something that you might want to offer to your employees, if you have a business, in the form of a number of different IRAs that match or that meet whatever their investment goals and objectives are, and all of which are available through Forge. And you really want a custodian that's flexible as you want to be. And if you're open to other types of assets, it's nice to be able to stay within one custodian and be able to do it all. And so the biggest thing that I see is if you're trying to do it yourself, throw a few questions into AI, like, you don't know what you don't know. Some of these rules can really grab you, right? Like, you may not know when it comes to a particular type of conventional, traditional IRA, you can just do one a year. Everyone knows about the mandatory withholding, but you may not know about the pro rata. So I would just encourage you, before you're deciding to do something like this, it's in your best interest to get an hour of billable time from whomever is preparing your taxes to say, I'm thinking of doing this, or I'm allocating a certain amount to invest. Is this going to trigger anything? And then they very clearly can lay that out for you a lot less expensively than an IRS penalty down the road. And so if you're converting with intent, know what you're doing, thinking about how you're going to build the wealth for you and your family, and then don't get tripped up along the way. Feel free to reach out to me if any questions jump up for you, especially if you're doing any types of transfer or doing a selling of your business. or research funds and life science companies that are going through the whole rigmarole of getting bought. And all of us are really invested in however we can help. and Forge is a great conduit of doing that. And now I'd like to tee it off to Lee Underberg, who really has a wealth of experience in all different types of these assets, whether it's the real estate, private equity, precious metals. We enjoyed connecting on a variety of things there, and he's a great person to start your onboard onto Forge.
Thank you so much, Rob.
Thanks, Rob. Hi, everyone. My name is Lee Underberg. I've been with Forge Trust going on 10 years, and I help clients with any sort of IRA question as far as how do I get started? What is my next step? How do I move my money? Here's where the money's parked at right now. And then once it's here, how do I invest it? What is the paperwork I need to do? So if you have questions on those types of steps or how to get started, I would be your main contact here at Forge Trust. My information will be here on the page. And I'm going to then turn it back over to Tia for any other questions.
Yes, thanks so much, Lee. Yes, thank you everyone to our panelists, Rob, Mike, Andy. Really appreciate the deep dive into your various topics. As everyone can see, there's a lot that when it comes to alternative investing with an SDIRA and a ton of benefits overall. And so everyone's contact information is up here on the screen, but we will go ahead and open it up now for a live Q&A. Let me get you guys off of mute here. And if you'd like, you can throw questions in the chat or you're happy to unmute yourself and we'll take any questions as they come.
Tia, someone actually just texted me a question.
Of course.
They asked, what's the minimum to open a self-directed IRA at Forge Trust, and what are the typical fees?
Yeah, great question. Thank you. So we have a $500 minimum in terms of fees. So we're not a bank, we're not a broker dealer. And so our fees are what allow us to operate as a custodian. That allows us to, do the proper record keeping, ensure compliance with the tax shelterment of your account. And so we have two sets of fees. Those are going to be quarterly recurring fees as well as transactions-based fees. And transaction-based fees would be, upon initiation of a transaction. And so typically it's $85 a quarter, and then there's an asset holding. And so those obviously should be considered in conjunction with your overall investment. But again, the IRS mandates that there be a qualified custodian to protect the integrity of that tax shelterment of the account. We'd also be happy to follow up with a fee schedule as well. Great question.
Mike, I get a common question along. Tell me about a typical client that may use a self-directed IRA with one of your projects. Tell me a little bit more about what that looks like.
Sure. So, kind of as was mentioned in the presentation, given especially where digital assets are right now, they're well off their highs. They're at depressed valuations. It makes a lot of sense to right now do a conversion either from a traditional to a Roth self-directed. So for those who have digital assets in a traditional IRA, they can essentially sell those assets, convert it into cash, and then work with Forge Trust and myself to then invest into Blue Coin Fund through a self-directed IRA custodied at Forge Trust. The fund is able to take on a wide variety of clients, high net worth individuals, pensions, as well as retirement fund. And the way that looks operationally, and I'm sure Tia and Yuli can dig into that more, is that the account is held in the name of the custodian. So it would be something like, Forge Trust IRA custody account for the benefit of individual client. And so it's in a qualified account. And if whether it's a self-directed traditional or self-directed Roth IRA, it would grow, their investment in Blue Coin Fund would grow in that qualified account. And if it was Roth, then it would grow tax-free. And if it was in a traditional IRA, then it would grow and it would be taxed when distributions are made.
Thanks, Mike. Looks like we have a question come in around. The question says, does Forge Trust have relationships with Fidelity or alts, or does it involve selling assets? So Forge Trust is strictly a custodian, okay? So in order for you to invest on our platform, you would come with the investment offering. So it would be by way of Mike or another fund sponsor, precious metals dealer, those types of things, okay? In order for you to purchase an alternative investment, you need that in cash because that cash would essentially fund the purchase of the alternative. And so anytime you're investing in an alt, it would be with cash. If you have current retirement funds, you would have to liquidate those and transfer in order to purchase. We don't have a direct relationship with Fidelity, but I do want to mention that we have actually recently been acquired by Charles Schwab. So we were acquired in March, and it sounds like integration with Charles Schwab's platform will begin in 2027.
Perfect. And then another follow-up question is, what's the relationship between Forge Trust and Andy's Wealth Management Partners? So,
Yeah, I could answer that. So, there's nothing formal yet, but Forge Trust has been acquired by Charles Schwab, which is our main custodian for client assets. And at some point, I definitely know that Forge Trust will be integrated, with the service offerings for our clients. It just hasn't happened yet. But at some point, probably in the near future, that there is going to be a more formalized partnership with Forge Trust because of the Schwab relationship. And to be honest with you, we do offer a lot of alternative investment, especially private equity and venture capital. And to have somebody like Tia and Forge Trust, it's going to make our lives easier, for our clients and not have these assets in taxable accounts.
Great call out, Andy. Thank you.
Thank you, Andy. This is Roger.
Hi,
Hey, Roger.
Roger.
Good to see you.
Good to see you, and thank you for the beginning.
Mike, we have a couple questions here for you. As someone's interested in convergence of AI agents and digital assets, what's the best way to gain long-term exposure to the opportunity without trying to pick individual winners?
Right. That's a great question. And age, age,
Hey, Mike, I think we're having some connectivity issues here. I believe you're freezing. Is anyone else experiencing the same?
Yeah. Yes.
Yes.
how about now?
Maybe Mike will turn off his camera.
Apologies, everyone, for the technical issues. Give us just a moment here, see if he can get some connection bandwidth. Looks like he's going to rejoin. So in the meantime, let me see if there's any other questions.
I do see these are good questions, so definitely grab Mike's information here, so we can have you contact with him. There he is. Hey, Mike.
Shoot. Yeah, can you guys hear me okay? Is it still
Yeah.
choppy? I can turn my video off. And that was an honest disconnection. I wasn't just trying to avoid the question. Yeah, so just let me know if it gets choppy, but yeah, great question. It's at an early stage. AI needs permissionless payment rails to make transactions, and that's exactly what crypto provides. It's at an emergent stage right now, and picking individual winners, it's kind of like venture style risk. Most will go to zero. You might get a unicorn every once in a while. So I'd say you can kind of think about it in terms of layers. At the base infrastructure, you have Ethereum, like Rob mentioned earlier, and Solana, where most agent payment activity actually is settling, right? So it's decentralized. It's like a publicly accessible ledger where value can move. And these networks capture activity regardless of which application wins. Again, they sit at the base layer. A second layer is picks and shovels, like equities. So exchanges and infrastructure companies that benefit from transaction volume, no matter whose agent wins. And then I'd say another level um, is I guess like a diversified, actively managed basket. Because in a fast-moving theme like this, the winners often rotate, and so you need someone whose job is to constantly stay on top of it. And this is an area where active management can really shine, and something like a passive ETF will just get left behind. So, ETH, Sol, and some crypto equities would be a great way and a safer way to capitalize on this trend.
Lee, you're on mute.
Great. So real quick here, Mike, another question is what percentage of retirement account would you recommend allocating to Bitcoin? Does it make sense to also have exposure to ETH and other assets?
So, in finance, they say the only free lunch is diversification. And I think Andy can kind of testify to that, and with his charts talking about, correlation and returns and all of that. So, you know, obviously you don't want to get any duds, and there's a lot out there, but to the extent you can focus on tokens and equities that will benefit, diversification is a added value to the process. So holding other tokens like ETH, I think, make a lot of sense. Historically, Bitcoin has been by far the best performer for a variety of reasons. It doesn't mean it's going to continue. And in terms of allocating to digital assets in general, I would say for most people, I would keep it under 5%, 5% just because of the volatility. It's much higher than what many people are accustomed to. BlackRock, Fidelity, a lot of these large players in their model portfolio by default, they have a 1% to 2% allocation, right? So it's definitely become much more mainstream. And depending on how young you are, you could have even more than 5%. So a lot of it is also depending on your personal situation.
Yeah, I just wanted to add to that. That's a loaded question to find out what specific percentage to allocate to those different asset classes. But just broadly, having a diversified strategy within the alternative space is basically what we recommend. A broad basket, just like your stock portfolio, just like your bond portfolio. You want to be diversified throughout the different strategies, and it really depends on your personal situation, your goals, the assets that you have. We always recommend to clients you just don't want to have all your eggs in one basket, chasing returns. That's not the most prudent thing to do.
Definitely. Awesome, guys. Do we have other questions? I believe we answered all in the chat, but feel free to flag us if not. Again, you're welcome to unmute yourself and ask any questions that you may have. Want to make sure everybody's getting the most out of this presentation.
Hi, this is Roger. I do have one question about age, in that many clients like ourselves are older, in their 70s, and it's very different, I suppose, for someone who is in their 50s. And is there a difference in how you would allocate in terms of crypto or alternative investments between those age groups, or between those age groups and portfolios?
I could take that one. Yeah, absolutely. Because every different alternative investment strategy has its own time horizon when things pay out. And liquidity is a big issue because if you are in your 70s and you are taking required minimum distributions, it makes it difficult if you have a big, like a portfolio fully invested in many of these strategies like private equity or VC. just because they're by nature they're not liquid. But with that said, one of the things I'm seeing is that most retirees are living a lot longer. That's been a trend that I've seen since the start of my career, like 25 years ago. And part of the reason why you want to hold some of these investments is to get some of that excess return because people are living longer these days. But it really is dependent on your individual situation and how much uh, funds that you're taking out of the retirement accounts and so forth when you are within the retirement age.
Thank you, Andy.
Yeah, thank you both. Great question. We've got about 3 minutes left in our time today. Any other questions, guys? Awesome. Okay. Well, if nobody has any follow-up questions, we sincerely appreciate everyone's time. Obviously, there's a very highly skilled panel here today, kind of covering all facets of the industry. Andy with the wealth management, Mike with his fund, as well as Robert around the taxes, and obviously Forge Trust for the self-directed IRA point of things. So again, we really value your time today. We really hope that this was an educational, informative session, really to open up your understanding around alternatives and the nuances of investing within a self-directed IRA.
Right.
And with that, guys, we appreciate it. We will follow up with a recap of this, of course, with all of this contact information. That way, if anybody does need to reach out and has any further follow-up questions or would like to meet one-on-one, we are all happy to support that. Amazing. Thanks, everyone. Have a wonderful day.
Thank you. Have a great
Bye.
day.
Thanks.
Bye bye.
Bye.